this balance will go to this. That is the link, right? Okay, now close the books. What does it mean, closing of the books? We talk about adjusting entries. First of all, we talk about recording. What does it mean by recording? Which means journalize the entry. Second, we talk about posting. What does it mean? We make T accounts or ledgers, right? And then we talk about adjustment entries. And fourth one, or the last one, is closing entries. So before just proceeding to this closing entries, so give me the answer, sales or revenue? We know that the accounting equation is assets is equal to liabilities plus owner equity. And in owner equity, we have two accounts, common stock and retained earning, right? So sales, expenses, dividend. What we talk about in our previous lectures, that these three belongs to which part? Sales belongs to retained earning. When we set the rules for debit and credit, we talk about that. Sale increase means retained earning increase. When retained earning is increased, it means owner equity increase. When owner equity increase means credit. We talk about over there, right? So sales belong to retained earning. Expense belongs to retained earning. We talk about that. If expense increase, it means retained earning decrease. When retained earning decrease, it means owner equity decrease. Decrease in owner equity means debit. Increase means credit. So that's why we talk about that. Expense increase always debit. And then also dividend, the same rule apply here. Dividend increase will decrease the retained earning. When retained earning is decreased, it means owner equity is decreased. So these all belong to retained earning, right? So it means every account we have already closed through adjustment entries, like like depreciation expense to accumulated depreciation, we close that account. So for example, the other one, which one? The previous rentals, we also created over there. We created liabilities, salaries payable, salary expense, right? And now we have to create it. Let me just give you the example here. We created T accounts and we take the balance to the trial balance, right? This is a debit and this is credit. And then we see that. So every account must be closed because this is the end of the year and we're going to close the books. And which books we are closing? Only those books which belongs to income statement, because income statement is what we have earned and spent during the year. It means income statement shows us what happened to the business during this year. How much we earn, how much we spend, and what is the total profit, and how much we spend as a dividend, or how much we distributed this profit among our shareholder. So it means income statement accounts will be closed permanently for the year. It means their balance is not carry forward. Whereas the balance sheet account, they will move on or carry forward. So that's why we see on the balance sheet accounts payable, account receivable, cash, right? But all those accounts that belongs to income statement must be closed. So we created, for example, this entry when we created salaries, expense to salaries payable. So answer me, which account should be closed? This will go to income statement and this will go to balance sheet. So balance sheet account we are not closing because their balance are carry forward to the next beginning, balance. But this account we should close. And how we close it? In double entry system, we have already make it debit, right? Are you guys with me? Okay, guys, you with me? You are with me?
Yeah.
Everyone?
Yes.
Lisa, Jackie,
Yes, yes, yes.
Okay. So when we created this entry, salaries expense to salaries payable. So payable belongs to balance sheet. This will go to balance sheet. It means its balance also go to the balance sheet. But expense is going to the income statement. So when we create this T account for salaries expense, for example, this was 40,000, this is 40,000, right? So this is 40,000. So closing the books of account, it means that the books have a zero balance here. But here we have debit balance, right? So all the expense or all those accounts, sales or revenue, expenses, they are basically income statement items, right? Sale minus all expenses and minus dividend is your net income, right? So we must close down their balance to zero. How are we going to close down? If we have some kind of entry that makes salary expense credit 40,000 as well, then this balance is going to be zero or closed, right? So this is possible. Why? Because the income statement items, this sales, expenses, dividend, they belong to retained earning, right? So when this entry happen, salary expense to salaries payable, this go to the balance sheet. We are fine with that because their balance is still on balance sheet. But this will go to income statement. So their balance is still debit balance. So when we make this entry to close down the salaries account, what should be the entry? Make that entry. It means salary expense is debit is credited. This is the credit side. Salary expense. And what is the debit side? Retained earning. 40,000. 40,000. When you post this entry here, this makes this account zero or close. So now let's proceed. Here we go. So closing the books means close the revenue, close the expenses, close the dividend. So you don't have to memorize all these, transaction, what should be the debit, what should be the credit. Follow the logic. When we sell the item, our sale or revenue account is credited. For example, this is the 140,000 because the normal balance of sales are always credit. The balance of expenses are always debit, and the balance for dividend are also debited, because increase in dividend is debited. For example, we paid 10,000 dividend. So when you close down the revenue, it means you have to write down the same amount, because sales belong to retained earning. So we say that this is debited by sales. It's debited by revenue. So when you close down the sales, entry would be this entry. You can make the entry. Sale is debited by retained earnings. So that's why debit. Let me just change the color. I think it is blue. Blue is okay. See, debit retained earnings. So this entry is retained earning to sales, right? Retained earnings, credit sales. Expenses. You see the expense already debited, and we credit by exact same amount, 40,000. What is this entry? Expense is credited by retained earning. So entry would be retained earning to expenses, right? Similarly, dividend, similar to this account, because we have to write down retained earning has credited the dividend account, 10,000. So the dividend is credited and debited is retained earning. So don't memorize all these. If you know the logic, you can create these entries by yourself. So here we go. So this is our trial balance, normal trial balance, and this is these are the adjustments. We just did that, and this is the final adjusted trial balance. So you see which items we need to close down. All those items, see, that belongs to income statement. So income statement, dividend, see, dividend is debited. So when we want to close it down, we make a credit entry. Sales, we make a debit entry. Expenses, we make the credit entry, which means we need to reverse the entries. So let's talk about that. I think we have a question here. Oh, we have the example first of all here. So this is what I talk about on a whiteboard here. So these are the entries